What the hell's going on, guys? So today I'm going to be walking you guys through my fifth highest paying dividend stock within my personal dividend portfolio, and that stock is WP Carey, or ticker name WPC. Uh, for those of you that do not know, WP Carey is a real estate investment trust, or REIT for short. Uh, More precisely, it's a triple net lease, meaning that it basically owns the buildings that everyone is basically in, but it's not responsible for property management. It's not responsible for paying for property taxes, and also they attain rent from the tenants that they're basically there. So basically, they just own the building, make sure that nothing goes wrong with it, and they sign, very long agreements. They basically pay insurance on the building and make sure that everything's okay with it. But other than that, they don't necessarily have to do anything other than own the building. So generally speaking, these types of investments are lower return, but obviously due to the fact that they don't have any sort of issues and they have a lot of rent and everything built into these long-term contracts, they're a lot lower risk as well. But they are very high capital businesses in the order of, some of these buildings go anywhere between 10 to $100 million. So um, that's just a little bit of an overview. So let me show you exactly how much this actually pays me in a year. So back in about March of last year, I purchased about 65 shares at about $61 a pop for just under $4,000. And that gave me a forward annual payout of $290. I'm sorry. And in terms of how much that actually is in my actual portfolio, it is just under 3% of my total portfolio in terms of value. I'm sorry, that's Disney. Hold on a sec. There we go. So just under 3% of my total portfolio. Actually, if I expand this out, anyway, I can't expand it out. But yeah, 3% of my total portfolio. And if you were to think about how much that actually is in terms of my forward income, about $6,500 a year at this point. So it's just under, it's just about 4.5% of my actual income coming from my 160-ish thousand dollar portfolio that is not including my 401k. Of course, if I wish I could, but I can't split out the dividends coming from my 401k. Otherwise, I'd be making a decent bit more than $6,500 a year. But anyway, I wanted to walk you guys through one of the main reasons why I invest in WP Carey, and walk you guys through their most recent quarterly report, and maybe that'll give you guys an insight as to one of the reasons why I invest in it. So WP Carey's been doing work, I guess, since the late 70s, so they've been around for about 45 years or so, of which the past 20 years they've been paying a pretty consistently updating dividend, or increasing dividend rather. But I guess really the company makes their money through two ways, and this is basically their business model here. So they own WP Carey, obviously, which is a lot of the buildings that they essentially manage and run themselves, and then they also do asset management for others, and that's also where a decent amount of their pipeline of future properties come from. So generally speaking, every couple of years they'll round up a portfolio for a couple individuals or other real estate investment trusts, as far as I understand it, and basically they take a percentage of that particular portfolio into the real estate investment trust as income. So in this case, 80% of the owned buildings that they have, which is the almost 900 properties at different annual rentals of around $700 million a year, gives them about 80% of their funds from operation. And that other 20% comes from the other assets that they kind of have under management, but not necessarily own. But most recently, they announced that they want to merge with this CPA 2017 portfolio, which is a global portfolio mixed between United States assets as well as other assets within Europe mostly, and that's a $5.8 billion merger. So yes, it means they might take on more debt. However, the cost of it in terms of the debt is relatively good, if I remember. I don't remember the exact numbers off the top of my head. But here's a little bit of what they basically have been doing. They basically take a lot of these CPA REITs, like I mentioned in the previous slide here, and they basically progress that forward through. So they basically manage it, figure out if it's a good fit. Maybe they spin off some of the assets within there, and then they acquire them through the actual mergers through there. So since 2012, for instance, about 70% of their acquisitions have come through assets that they've managed in that small 20% part of their portfolio. And the other 30% or so are basically coming from actual, tenants and actual operations that they're going out and investigating to purchase. And that's not really including that $6 billion or $5.8 billion merger with CPA 17, if that makes any sense. So don't really want to talk about that one, but I guess this is how they do a lot of their asset management. So they have offices in New York and Amsterdam, and that's kind of that part of it. But what I really want to touch on is their huge portfolio. What they have, they almost have 900 properties, of which they're making about $700 million a year in rental income. But I think what the coolest part is that it's not all U.S. based, so it's a good opportunity to own U.S. based triple net real estate, but also European and also Mexico and Canadian. And I can get into that a little bit more. And another thing that's just pretty interesting is that they have some of their rents are manually increased on a set basis. So 27% of them, for instance, might be raised 2.5% per year, which I think is pretty interesting. They have a phenomenal occupancy rate, which I think you'll see on the next slide. Over the past couple of years, it's like never dipped below 99%, which is absolutely phenomenal. And that's basically that. And then obviously they boast a pretty high investment grade tenant percentage comparatively to their annual revenue stream. So here's actually their top 10 tenants, which I thought was kind of cool. It's really changed over the past couple of years, and it's actually really cool to look at what Realty Income Corp's top 10 tenants were in 2008 compared to what they are now, and it's completely swapped. Like, it used to be more retail, obviously, as Amazon and the online businesses have really started to erupt in terms of continuing to increase their revenue streams. A lot less people are doing retail, and they're more doing industrial, office, warehouses, self-storage, and whatnot. So it's really cool to see the split out for WP Carey, where they're mostly industrial, then their secondary is office. Retail is actually, kind of middle of the pack, which is interesting to see. But U-Haul I thought was pretty cool because 5% of that. Hellweg, I have no idea what Hellweg is, but a lot of these things are pretty cool. I wouldn't expect them to be such a large component of such a large global portfolio like True Value and these other Universal Technical Institutes and whatnot. And here's another breakdown of, say, the other things that they have, like consumer services, automobile, and whatnot. And like I said, WP Carey doesn't just necessarily invest in strictly United States. They look at everywhere. So you're like 65-35 U.S. compared to Europe and Mexico and other places like that. So it's really interesting to see some of the businesses that they're applying to acquire in like the UK and Germany, which is kind of interesting because they're more lower cap rate buildings. But for instance, they might appreciate a lot faster in that respect. And here's how they basically have their rent increases built in to their contracts that they have here. And I think this is really interesting because it shows you the lease expiration by each contract, and this is assuming that they don't renew the contract, right? So generally speaking, 95% of the time, they basically only have 1/20th of the leases going up for renewal, with some exception in like 2022 and 2024. But that's not to say that half these people, or 60 or 70% of those people, won't renew in another 10-year or 20-year contract, which I think is really interesting. And this is kind of what I was talking about earlier. Okay, maybe I exaggerated saying it never went below 99%, but never gone past 96% in the past 12 years, which I think is phenomenal. Even during the financial crisis, it dipped from 99, 98, down to 97, high 96, and then back up to 99.6%, which I think is absolutely phenomenal. Here are some of the industrial type warehouses that they've bought or purchased in recent times. And another cool thing is the balance sheet. Won't get too much into that, but what I really want to show you guys is the dividend growth. So if you've actually purchased this 20 years ago, you've experienced phenomenal dividend growth of over 100, 150%. And more recently, looking at it in terms of adjusted funds from operation, they're continuing to grow just since 2013, when they kind of made themselves an actual public conversion to a real estate investment trust. They've gone from $3.39 all the way up to $4.08. They generally raise the dividend half a penny every quarter. As you can see, it's generally been like that over the past couple of years. But they're consistently increasing the adjusted funds from operation to make sure that the payout ratio is staying below 80%. And I think that's phenomenal, because if you're seeing a decent 2-3% growth a year, that means you're immediately going to be getting 2 to 3% growth in your dividend. And then, of course, with the addition of major CPA additions, or the assets under management additions into the actual real estate investment trust, that means that this dividend can only go up from there. So it's absolutely phenomenal. And then it kind of touches on some of the issues that they do with respect to merging with some of these things, and what kind of portfolio they would be merging with if they do the CPA 17. But it's really interesting. I think it's a really well managed company, and I on any pullbacks, major pullbacks, or when I have time to fund more in my Roth IRA, because this is in my Roth IRA, I will definitely consider adding to this position if I sell out of any of my other positions in my Roth IRA, like my Icon Enterprises, my First Solar. If for some reason I transfer out of my BHP, which is another top 5 dividend payer for me, or my Philip Morris, if that runs up substantially and I decide to get out of it, I'll definitely consider getting involved more heavily into WP Carry. It's a decent dividend payer. 6.5% is my yield on cost at the moment. 6% based off of what the actual current price is. And like I said, they raise it about half a penny every quarter, so it's just going to continue to go up every single quarter, by the order of 2 cents or so, which is absolutely phenomenal. So if you guys have any questions about WP Carry or anything else, feel free to leave a comment down below. Like I said, this is my top 5, or my 5th best dividend paying stock. I'll be running through the other couple dividend paying stocks that are in my top 5 in the next couple videos. So if you guys have any questions about why this is a top 5 dividend paying stock, feel free to leave a comment down below. And otherwise, I will talk to you next time.